Hi everyone, welcome to Standing on Business. Today we'll be analyzing On Holdings to determine if it's worth your money. This recording is as of August 13th, 2025. If you're new to the channel, my name's Mishka.
I'm Pahel.
And my name is Mariah.
Together we have created a framework and point system to evaluate the performance of different companies. There are 5 key pillars to look for: product/services, management, financials, valuation, and sector tailwinds. Each pillar is weighted differently based on their importance in making stock-related decisions.
Okay, let's begin with our first pillar, the product analysis. It's worth 10 points. Before we get into the points, here's some background. On Running is a Swiss activewear company in the consumer discretionary sector. The company specializes in running and walking shoes, but it has recently come into the apparel and fashion market as well. The stock ticker is ONON. Here's a table displaying all the point values we gave On for this section. We gave On 7 out of 10 points, and here is why. We gave 1 point for the company generating over $100 million in revenue, as we consider that a really good barrier to pass. Another point was given for having consistent revenue growth for the past 3 years, showing that the company is not declining. And we gave another point for the revenue that is expected to rise in the next year based on analyst forecasts for the next 12 months. By the way, we get all of our data from financial sources like Yahoo Finance and fiscal.ai. If you want to follow along using company balance sheets and income statements, the websites will be linked down below. Moving on, we're granting On half a point for having first mover advantage. This is the advantage companies gain from being the first in their kind. On is a relatively new brand compared to established activewear companies like Nike and Lululemon. However, their shoes have a new and innovative design that hasn't been seen before, and for that reason, it gets half a point. Next, we give another point for On being a top product. On shoes are one of the best in their sector, with a lot of hype on social media, influencer brand deals, and overall shoe quality. Unfortunately, On does not get the point for having entry barriers. The apparel industry is relatively easy to get into compared to other industries like tech and energy. Next, a razor blade model is basically an analogy for companies being able to retain customers for a second or third buy. In On's context, we gave the company half a point as customers aren't obligated to make a second or third purchase of their products. However, many loyal customers do come back for more. Another point is given for On having over 100 customers. Most retail companies get a point for this one as they don't have consumer concentration. Next, On does not get the point for having network effects. Network effect is basically when a brand's product gains more value if more people use it, and that's just not the case for On Running. And lastly, 1 point is granted for brand image. While there are people who probably dislike the brand, the company doesn't have any negative associations with its name. So overall for this section, On gets 7 out of 10 points.
Our next pillar will be analyzing management, which includes company leadership, vision, and capital allocation. Let's dive in. To begin, we started by looking at the CEO Martin Hoffman and his track record. We gave it a point because he has been able to lead the company into a lot of financial growth over time and has been involved with On for quite some time, currently serving as the company's CEO and CFO. Next, we are giving another point for the company's other executives for having a good track record. The company still has its founders as part of the management and board, which is always good to see. Also, looking at the company's proxy statement, many of the current management members hold significant company shares. Next, another point is given for integrity and transparency. As of now, On has not had any serious issues with withholding information, and overall it has been transparent in all of its public communications. Another point is given for the company having a strong vision. Starting in Switzerland, the company has been able to grow exponentially and is now a big brand globally. The company has expanded into clothing and apparel and is growing rapidly in the Asia Pacific. We are giving another point for insider ownership. The management of On Holdings owns about 13% of the company, which is extremely favorable. Unfortunately, no point is given for management rating by employees. We got our data from sites like Glassdoor and LinkedIn, and On Holdings only scores about 66%. A point is not given for company dividends. On Holdings does not offer dividends as of right now, and while that is okay, many investors may not like that about the company. It just shows how right now On's management is allocating the money elsewhere. No point is given for buybacks. When companies buy back shares of their stock, it is usually a good sign as it shows management believes the company is undervalued. Next, no point is given for shareholder dilution. Right now, On is issuing a lot of shares for employee compensation. This means that each existing stock represents a lower percentage of the company. And lastly, a point is given for insider transactions. This point goes back to the idea that executives buying stock in the company is a positive indication, and recently, Mark Maurer, an executive, bought 2.7 million in shares, which is a good sign. Overall, for the management section, On Holdings gets 6 out of 10 points.
Alright, now we're moving on to the third pillar, which is the company's financials. Let's dive in. Here's the table with all the point values we're giving for this section. We gave On 8.5 points out of 10. First, 1 point is given because the company is GAAP profitable. That means that On does make a profit. The next section is worth 2 points and we give it 1 out of 2. FCF stands for free cash flow. It is healthy for companies to generate free cash, and the reason On only gets 1 point is because the amount of cash generation over time doesn't show consistent growth. Again, all these metrics can be found on the sites linked below. Next, for debt, On has a great track record with debt, with 0 debt, which is why it gets 2 points. Next, for margins, we give On 1.5 points. On Running's gross profit margin has increased over the years, which is a good sign. However, its operating margin has been fluctuating, so some years it'll be higher and some years it'll be lower. Another point is given for not having excess goodwill or intangibles, which can often inflate the asset side of the balance sheet. Next, another point is given for having a good current ratio. With the ratio being 2.67, the company has enough liquidity to cover all of its operations and liabilities. And lastly, On Running gets another point for having a rising book value over the past few years. Book value represents the company's equity, and having increasing equity represents a healthy balance sheet. For this section, On Holdings gets an 8.5 out of 10.
This brings us to our fourth pillar, valuation. Weighted at 30 points, valuation can be the deciding factor between buying and selling a stock. We have broken valuation into 3 subcategories, each valued at 10 points. On's valuation compared to peers, valuation compared to its own history, and revenue growth compared to peers. Let's dig into subcategory 1, valuation compared to peers. In this video, On will be compared to Nike Inc., Deckers Outdoor Corporation, Lululemon Athletica Inc., and Saucony Inc. In this category, On's valuation is compared to the average valuation of peers in industry through analyzing ratios such as PE, P over FCF, EV over EBITDA, and EV over sales. These ratios help show if a company is priced reasonably. On's PE ratio is 196% higher than the peer average. On's P over FCF ratio is 78% higher. On's EV over EBITDA ratio is 140% higher, and On's EV over sales ratio is 129% higher. So On is clearly valued very richly compared to peers on traditional ratios, which earns them 0 out of 10 points. We can now move on to subcategory 2, On's valuation compared to its own history. In this category, On's PE ratio is compared to its average PE ratio from the past. On's average PE ratio from the past is 89.71. In contrast, On's current PE ratio is 61.8, approximately 31% lower than the average of its past. And since 1 point is rewarded for every 5% lower, On scores 6 out of 10 points on this subcategory. Now that On's valuation ratios have been thoroughly analyzed, it's time to move on to subcategory 3, On's revenue growth compared to peers. On's peer revenue growth average over the past 4 years was 110%. In comparison, On's revenue growth over the past 4 years was 596%. In addition, On is expected to grow at a rate of 30% or higher this year based on the latest earnings release, which is impressive compared to the single-digit expectations for its peers. Since On's revenue growth flew off the charts, it earned itself 10 out of 10 points. All in all, On earned a total of 16 out of 30 points on valuation.
Now, let's move on to the final section. Not all stocks can be evaluated the same because of what sector they are in. For example, even if 2 companies have the exact same financials and valuation on paper, one stock can be a better buy because of what sector it's in. On Holdings is in the consumer discretionary sector, one that has things people want but don't need. Here are the point values we gave to On for this section. Because of increased tariffs, consumers have been slightly scared about buying discretionary goods. However, since employment is stable, it is one step in the right direction. So, we are giving the company 3 points.
And that concludes our analysis. Based on our point system, On Holdings earned 40.5 points out of 65, equating to about 62%. Based on our standards that we highlighted earlier, we suggest that you add this stock to your watch list or hold it if you already own it. It definitely has potential, but it might be a little expensive at the moment. And that's all we have for you today. Please remember to tell us your thoughts or feedback. Thank you for listening to this episode of Standing on Business. We'll see you next time.